The earnings results for Australian companies reporting full year results and half year results for August 2013 can best be described as reasonably solid, in particular in respect to expectations. So overall earnings for the market declined 3.1% for the year, but this really can be broken into two pieces, and that is the resource company earnings and the non-resource company earnings. So resource earnings actually fell 27% for the year, and non-resource company earnings actually increased 5% for the year. Within that, the key buckets were the industrials, which had 4.8% growth, and again, if we exclude mining services from that portion, they actually grew close to 7%. The banks delivered 6.5% earnings growth, and the listed property trusts had quite a flat year, delivering only 0.3% earnings growth for the year. So overall, in summing up for that, we can say that it was a solid reporting season relative to expectations. What we did see was that this was actually well received by the market. So the ASX 200 accumulation index during the month of August increased by 2.5%, which was much better than the offshore peers. The S&P 500 fell 3%. The MSCI World fell 2.3%. The only other standout was within our region, and that was China, who had a bit of better production data, actually increased 5.2%. So there are a few themes that emerged throughout the reporting season, and the first one of those was that there were no major earnings disappointments. Now, this is quite different to the last few years where we've gone into reporting season with a set of expectations and forecasts, and these have been materially downgraded. So that's been quite a positive outcome relative to previous years. The second was that revenue growth was very insipid. So companies ex resources only grew their earnings 1.6%. So we're in a low growth environment. The third thing was that cost control was pretty strong right across the board. And the reason for this is that a number of industrials companies have actually been in recession or effectively in recession for 5 to 6 years. So management have had a lot of time to adjust to a low growth environment and start to focus on cost and capital initiatives. What we've seen is the banks also had excellent cost control, and they probably moved to that mindset about 4 years ago, so there's really some evidence of that coming through now. What's really happened over the last 12 months is the resource companies have welcomed this mindset as well. So with commodity prices sort of declining and China growth slowing, we now see firmly that resource companies are starting to focus on capital, how much they're spending, and also what costs they've got within their business. So overall, on those, we were very pleased. The flow on of that is, or the corollary of that is that balance sheets, which were already in pretty good shape, actually improved, and that cash flow generation has been a focus and was quite strong. What we did see coming from a number of companies was higher payout ratios and higher dividends, and also the emergence of buybacks in some companies that hadn't done this before. So pleasingly, those themes from an earnings perspective were well received, but more importantly for us, the focus remains firmly on cost control, the strength of the balance sheet and cash flow generation, because we think we're in a low growth environment into fiscal 14 as well. For those investors in the direct Australian equities portion of the portfolio, we were quite pleased with the outcome that we experienced in August. So the portfolio delivered a return of 2.9% versus the S&P ASX 200 accumulation index of 2.5%, so outperformed by 0.4%. On a rolling 12-month basis now, that portfolio is delivering 29.4% performance versus the market at 25.3%, so outperformance of 5.1%. In August though, what we were particularly pleased about is that individual stock selection and portfolio construction delivered a very strong result, because the two big sectors that we have a large underweight position in, and that is the resource sector and also the financials or the banks sector, both outperformed the market quite strongly and delivered a fair amount of that 2.5% return. So companies like Challenger Financial Services, Domino's Pizzas, 21st Century Fox, Santos and Navitas were among stocks that performed well in excess of the portfolio and drove the result for the direct equities portfolio. Over the past 12 months, the Australian equity market has rallied 24% on an accumulation basis, which is a very strong result. We expect a positive result for the equity market over the coming 12 months, however not as positive as that we experienced in 2013 fiscal year. The reason being is the market going back 12 months ago was really cheap, and it was reflecting concerns about the global economy. The market then re-rated and is now trading in line with its long-term historical averages, as the outlook for the global economy, or expectations for the outlook on the global economy, have improved somewhat. So we don't think that the market is overly expensive. We think it is more a fair value type argument, which means that the returns or the future returns for the market are more likely to track earnings growth from here. So we see the outlook for the Australian equity market reverting back to more like historical norms, being in the 7 to 8% type range for capital appreciation.